Well, it's not just the UK economy that is feeling the effects of the so-called Brexit vote. The impact could spread to other weaker parts of Europe, like Italy, and potentially cause more serious problems. Caruso Cabrera explains.
More than a week after the vote in the UK to leave the European Union, there is one clear victim. It's the Italian banking sector. Italian banks have fallen more than 30% since the vote, and year to date, they are down more than 50%. The Italian banking system has long been troubled, swamped with bad loans, and they need more capital. The world was reminded of this yesterday when Monte dei Paschi, that's the world's oldest bank and Italy's third largest lender, informed the market that the ECB, the European Central Bank, was demanding that they do even more to clean up their balance sheet. So their stocks and bonds have fallen even further. Italian banks overall have an estimated 360 billion euros, that's roughly $400 billion of non-performing loans. So no one disputes that the banks need the capital. What there is a dispute about is how the banks should get that money. The Italian prime minister would like the government to help out the banks. However, new Eurozone rules that went into effect on January 1st prohibit a government from using taxpayer money to bail out a bank. That is, unless they first punish the shareholders and the bondholders. And in Italy, it just so happens a lot of retail investors, what we call mom and pop investors, hold bonds that could potentially get wiped out or suffer severe losses in the event of a bailout. Prime Minister Renzi wants an exemption to those rules, and he says Brexit justifies that. So far, the Germans and other members of the European Union disagree. However, there are growing concerns across Europe that if small investors believe they've lost money because Italy belongs to the European Union, it could lead to even more demands for a break from that union. For Nightly Business Report, Caruso Cabrera.